Hello everyone, and welcome to this presentation on the CFA Level I exam for June 2014. In this presentation, we'll look at the financial reporting and analysis section of the exam, reading 23, which is financial reporting mechanics. In this presentation, we'll go over practice problems over all of the learning outcomes. There are 7 learning outcomes of this reading. We start by looking at the relationship of financial statement elements and accounts and classify the accounts in the right category of financial statement elements. We then look at the accounting equation. Next, we look at the process of recording business transactions. We then look at accruals and other adjustments necessary for preparing financial statements. Then we look at the relationship among the different financial statements. We look at the flow of information in an accounting system. And finally, we look at how the results of the accounting process are used for the purpose of performing security analysis. In this presentation, we'll go over practice problems over each of these learning outcomes. Let's start by looking at the first learning outcome, which looks at the relationship of financial statement elements and accounts. Now, what are financial statement elements? These are items such as assets, liabilities, equity, revenue, and expenses reported on the financial statements. Accounts are the individual records of changes in these financial statement elements. For example, cash is an account within assets category. Notes payable is a liability. Retained earnings is a part of equity. Sales revenue is part of revenue, and cost of goods sold is a part of expenses. Now let's look at some practice problems based on this outcome. Let's start by looking at the first problem under the first outcome. Blank is an example of an asset account. Well, in order to answer this question, we should know what all these 3 items, these 3 choices mean. Let's start by looking at unearned revenue. Unearned revenue is when a company receives cash, but the service has not been provided yet. What will be an example? Suppose you subscribe to a magazine and you pay for the next year's service in advance. Suppose the subscription cost is $100. You pay $100 to the company for the next 1 year. Now the company hasn't provided you all of the magazines yet, and therefore that $100 actually is unearned revenue. It needs to provide the service to earn this $100, and if it cannot provide you those magazines for the rest of the year, it'll have to return your money. Therefore it owes you the service, and therefore unearned revenue is a liability. Let's look at retained earnings. Retained earnings is all the income that has not been paid out to the owners of the company in the form of dividends. That's the amount of earnings retained in a particular year. Retained earnings can be used to grow the company in the future. It's a part of equity, and therefore retained earnings is not an asset. Prepaid expenses. Prepaid expenses is when you pay cash, but the service has not been received yet. For example, let's say you're renting an apartment and you pay the next month's rent ahead of time. This will be a prepaid expense for you because you haven't lived in that apartment yet, but you have paid for the next month's rent already. That apartment will provide you a benefit. You'll be able to use the facilities for the next 1 month. It will provide you a benefit, and therefore prepaid expense is an asset. So A is the correct answer to this question. At the end of that month, you would have used that apartment, and prepaid expense will be expensed on your income statement, and this asset will be eliminated. Notice that your prepaid expense, which is an asset to you, represents an unearned revenue for your landlord. So the same transaction for the tenant is an asset, it's a prepaid expense, and for the landlord it's a liability. He has to provide you access to that apartment, and it is unearned revenue. Unearned revenue. Let's look at the next question. Which of the following is a contra account? Now, what's a contra account? A contra account is an account that reduces the balance of another associated account. Let's look at all three of these items in turn. Sales revenue. This books records sales generated by the company. It does not reduce the value of any other account. So this is not a contra account. Accounts receivable. Accounts receivable, it tells us the amount of cash the company expects to receive from the sales on which cash has not been received already. So this tells us the amount of cash expected to be received. Again, this is used for sales made on credit. This is also not a contra account. This does not reduce the value of any other account. Accumulated depreciation. This account records the total depreciation of an asset. For example, suppose you have a computer for $1,000. Now the computer is an asset. And assume that the accumulated depreciation is $300. The value of the computer, the net asset value for this computer, will be reduced to $700. $1,000 minus $300. Accumulated depreciation reduces the value of the computer, an asset in this case, and is a contra account. Let's move on to the second outcome, which looks at the accounting equation in its basic and expanded forms. Now, a fundamental balance sheet equation is that assets equal the sum of liabilities and equity. Call it equation 1. This is true. This is always true in order for the balance sheet to balance. Now equity in turn is the sum of contributed capital from its owners plus retained earnings. This is the earnings that has not been paid out to the owners. This is the earning retained by the company. Call it equation 2. Now the ending retained earnings for a company, ending retained earnings, is the sum of the beginning retained earnings plus net income minus dividends paid out to the owners. Let's call that equation 3. Net income in turn is the difference between revenue and expenses. Now if we plug in equation 3 into equation 1, we get assets as a sum of liabilities plus equity, but we know that equity is contributed capital plus beginning retained earnings plus revenue minus expenses minus dividends. Call it equation 4. Equation 4 is the expanded form of the accounting equation 1. Assets equal liabilities plus equity, that's equation 1. The basic form and the expanded form tells us that assets equal liabilities plus contributed capital plus beginning retained earnings plus revenue minus expenses minus dividends. And all of this item here represents equity. Now let's look at a practice problem based on the accounting equation. Here we have the financial information for ABC Inc. at year end. And we need to find out the amount of beginning retained earnings for the period just ended. The simplest way of solving this problem is by writing out the expanded form of the accounting equation. So we know that the assets equal liabilities plus equity, which is contributed capital plus beginning retained earnings plus revenue minus expenses minus dividends. Assets equal liabilities plus contributed capital plus beginning retained earnings plus revenue minus expenses minus dividends. Now the amount of assets here is $1,000. So we just plug in all the numbers. Liabilities are 300, contributed capital is 200, beginning retained earnings is unknown, revenue is 120, expenses are 80, and dividends are 50. This means that assets equal 620 minus 490. So 490 plus beginning retained earnings. That implies that beginning retained earnings is $510. Therefore, C is the correct answer. Now let's look at the third learning outcome of this reading. which looks at the process for recording business transactions. The first problem for this outcome. On April 30, Superior Minerals Inc. paid $1,000 in rent for the month of May to its landlord, McLaren Enterprises. Which of the following represents an accurate recording of this transaction? We saw earlier in this presentation that prepaid expenses such as rent are an asset because the person paying the money expects to receive a benefit in the future. In the case of Superior Minerals, it has paid the rent for the month of May for the next month in advance, and therefore its asset, prepaid expense has gone up by $1,000. However, its cash has gone down by $1,000 because it has paid that cash to its landlord. Therefore, there is no change in assets for Superior Minerals. From the perspective of the landlord, McLaren Enterprises, its cash has gone up by $1,000 because it received the money, but its liability, unearned revenue account, has gone up by $1,000 because it has not provided the service yet. It still owes the service. It still has to let Superior Minerals use that apartment for the month of May. It has received cash, hasn't provided the service. It's a liability, and therefore A is the correct answer. No change in assets for Superior Minerals, and increase of assets and liabilities for McLaren Enterprises. B is wrong because this entry here should be under McLaren Enterprises, and this entry here should be under Superior Minerals Inc., which is the option A, the correct answer. C is interesting. C is the entry we expect to see at the end of May. At the end of May, Superior Minerals would have received the service. Its prepaid expense will be reduced to 0. So prepaid expense will go down by $1,000. Its rent expense will go up by $1,000 because it has received that service, and expenses reduce equity, so equity will go down by $1,000. So C will be at the end of May, where the assets will go down by $1,000, the prepaid expense will go down to 0, and rent expense will go by $1,000. Therefore, it will drive down equity by $1,000. At the end of May, McLaren Enterprises would have completed its service. It would have provided the service. Therefore, its unearned revenue account will go down by $1,000. Therefore, its liabilities will go down by $1,000. And its equity, its income, it has actually earned the income at the end of May. It has provided the service for the month of May. Therefore, its rental income will go up by $1,000. And income increases equity, and so its equity will go up by $1,000. But C is only true for the end of May. We are currently looking at end of April, and therefore A is the correct answer. Now let's look at the next question for this outcome. Superior Minerals Inc. completes the sale of its product for $1,000 on credit. The cost of the product sold was $600. It should record the transaction as. When we look at all of these three options, we should know that C is definitely wrong. The reason is that it says that there was an increase in unearned revenue of $1,000. Unearned revenue goes up when we haven't provided the service, but we have received cash and we owe the service to the customer. In this case, cash has not been received. It was a credit sale. And further, the service has been provided. So C is definitely wrong. That leaves us with A and B. Let's look at A. Increase in sales revenue of $1,000, that's correct. Increase of cash of $1,000, that's wrong. That's because we haven't received the cash yet. it was a sale on credit. Furthermore, A says that there was a decrease in inventory of $1,000. It should actually be $600 because the cost of the product sold was $600, which makes B the right answer. Sales revenue and accounts receivable went up by $1,000. Cost of sales was $600 and inventory went down by $600. B is therefore the right answer. Let's look at outcome number 4, which talks about the need for accruals and other adjustments required for preparing financial statements. On the 1st of January, a company borrows $12,000 at an annual rate of 10% for 2 years. Interest is payable at the end of every year. On January 31, it should adjust its accounts by increasing interest expense and... Now we know that the company pays interest at the end of every year. Therefore, it will not be paying cash at the end of January, and therefore C is wrong. Let's look at B, increasing accounts payable by $100. Now it is true that interest expense or interest payable is a liability, but it's not captured in accounts payable. Accounts payable is used for items such as inventory when the company owes money to its suppliers. It's not used for interest. A is the correct answer, an increase in the interest payable liability account of $100. Next question. Superior Minerals Inc. is recording the $4,000 accrued salary owed to one of its employees. The treatment that best captures this transaction is an increase in salary expense of $4,000 and now this is an accrual entry. Cash has not been paid and therefore A is not the right answer. As we saw in the previous question, accounts payable is used for inventory for amounts owing to suppliers. Therefore C is also wrong. B is the correct answer, an increase in salary payable account of $4,000. Next question. A company records revenue and establishes an asset. The cash movement for this transaction did not occur in the period when the sale was made. The company must have been recording A. Now, let's look at all of these three options. Prepaid expense. Prepaid expense is an asset, but it is not associated with any revenue. Prepaid expense, this account is generated when we pay cash in advance for some service that we need to receive in the future. It is not associated with any revenue. So while it is an asset, there is no associated revenue entry. So A is wrong. Unearned revenue, option C. Unearned revenue is generated when we receive cash, but we haven't provided the service yet. Unearned revenue is actually a liability. And so C is also wrong. Unbilled or accrued revenue, that's the right answer, option number B. Unbilled revenue is, it usually occurs when the accounting period ends before the customer has been billed. So unbilled revenue is an asset, and there's an associated revenue account, sales revenue, which goes up. And therefore B is the right answer. Next question. An accountant forgot to make an adjusting entry for accrued salary. As a result of this oversight on the financial statements, the accountant forgot to make an adjusting entry for an expense and a liability. Since he has not recorded an expense, expenses are understated on the financial statements, and therefore equity is overstated because expenses reduce equity. Now, expenses are understated because salary expenses have not been recorded, and therefore the income is overstated, making C wrong. Option B is the correct answer because liabilities are understated because accrued salary, which is a liability, has not been recorded, and equity is overstated because salary expense, which reduces equity, has not been recorded. Therefore, equity is overstated. B is the right answer. Now let's look at the fifth learning outcome, which talks about the relationship among the different financial statements. The profitability of a company can be best assessed by. Now, the balance sheet of a company provides information on the assets, liabilities, and equity of a company as of a particular date. It would tell us how much cash the company had on a particular date, for example, but it does not talk about how much income the company generated. Therefore, A is wrong. C is also wrong because the cash flow statement tells us about the sources of cash and the use of cash. It does not talk about how profitable a company was. B is the right answer. The income statement tells us how much revenue the company generated and the different kind of expenses it incurred. It tells us the net income earned by the company. Therefore, it tells us how profitable the company was. Income statement, option B, is the right answer. Next question. An analyst would prefer that a company generates most of its cash from. Now, investing activities, operating activities, and financing activities are three different types of activities reported on the cash flow statement. There are three different sources of cash. Investing activities refers to acquisition and disposal of long-term assets, such as plant, property, and equipment. Now, this is not a sustainable source of cash flow for the company because a company cannot keep selling its plant, property, and equipment to generate cash because it won't have anything to produce its goods with. Therefore, A is wrong. Financing activities, option C. This relates to obtaining or repayment of capital. For example, issuance of equity, issuance of debt, paying down debt, etc. Financing activities is also not a sustainable source of cash flow because a company cannot keep issuing new equity or keep borrowing money to generate cash. C is also wrong. Operating activities. These activities represent the day-to-day transactions of a company. For example, the sale of iPhone by Apple Corporation. In the long term, the company should be generating most of its cash from its core business operations, from its operating activities. Therefore, B is the right answer. Let's move on to the next outcome, which talks about the flow of information in an accounting system. The collection of all accounting entries sorted by date can be found in. Now, the trial balance provides the ending account balance for all accounts. It does not sort these entries by date. It just provides the ending balance for different accounts as of a particular date. A is therefore wrong. The general ledger shows all the business transactions by account. It sorts all the entries by account rather than date, making B wrong. C, general journal, is the right answer. This sorts all the accounting entries by date. Next question. The flow of accounting information can be most accurately depicted as: now when a business transaction occurs, it is first recorded in the general journal. Therefore, B is wrong. From the general journal, it goes to the general ledger, making C wrong. From the general ledger, it goes into the trial balance, which provides the ending balance for all the accounts. From trial balance, we get to the adjusted trial balance, which makes adjustments such as accrual entries, and then we prepare the financial statements from the adjusted trial balance. The general journal sorts all of the business transactions by date. The ledger sorts all of these by account. The adjusted trial balance provides the adjusted ending balance for all accounts. And then we prepare the financial statements based on the adjusted trial balance. A is correct. Now let's look at outcome number 7, the final outcome of this reading, which looks at the use of the results of the accounting process in security analysis. An unscrupulous accountant wants to increase the amount of sales revenue recorded in a particular period. A common approach of doing this is by increasing sales revenue and... Now, for this kind of recording, cash is generally not increased because the amount of cash can be easily verified in an audit. The unscrupulous accountant will probably not do that. Inventory. Now, if you're increasing the amount of sales revenue, people will expect your inventory to go down. And so the unscrupulous accountant will probably not do this either. It's probably increasing the accounts receivable because this will give the impression that sales have been generated on credit. And unlike cash, accounts receivable is a bit more difficult to verify in an audit, and therefore C is what the unscrupulous accountant will probably do. Now this brings us to an end to this presentation. I hope you found it useful. Thanks very much for watching, and I wish you the best of luck.